Maruti Suzuki has been growing along with the Indian auto industry. We would like to strengthen further our fundamentals.
Suzuki, the iconic Japanese automaker known for its compact cars, motorcycles, and robust presence in emerging markets, has recently been thrust into the spotlight for reasons that have startled both industry insiders and longtime consumers. During a candid revelation that sent ripples through the automotive world, CEO Toshihiro Suzuki confirmed that the company is grappling with severe financial issues. While the public face of the brand had for years projected stability and quiet endurance, this sudden exposure of internal struggles marked a dramatic turning point in Suzuki's long-standing narrative of resilience. Before we start, smash the like and subscribe buttons for more updates. The announcement itself was steeped in the language of urgency, hinting at deeper troubles than previously understood. Though Suzuki has often been perceived as a brand that thrives in the shadows of larger Japanese automakers like Toyota and Honda, it has historically enjoyed a niche carved through affordability, reliability, and pragmatic engineering. That image, however, is now clouded by the revelation of financial strain. Not minor turbulence, but what appears to be a major upheaval with far-reaching consequences. It underscores a serious reevaluation of the company's operational foundations and raises alarms across the automotive supply chain and global markets where Suzuki plays a significant role. To grasp the magnitude of the financial problems facing Suzuki, one must first appreciate the structure and nature of its business model. The company has long leaned on a strategy of dominating less saturated markets, particularly India, Southeast Asia, and parts of Africa, where demand for cost-effective transportation remains strong. In these regions, Suzuki has often outpaced global competitors by offering vehicles that are both affordable and mechanically simple, a model that has earned it immense loyalty. But the very markets that once promised endless growth have in recent years become battlegrounds of increased competition and shifting consumer expectations. Regulatory frameworks have evolved, demanding more environmentally friendly vehicles and adherence to advanced safety standards, areas where Suzuki, traditionally more conservative in innovation, has lagged behind. Mounting costs associated with regulatory compliance have exacerbated the situation. In countries like India, which represents Suzuki's most lucrative market via its subsidiary, Maruti Suzuki, the demand for cleaner emissions and better safety technology has rapidly intensified. This regulatory pivot requires immense investment in research, development, and infrastructure, areas where Suzuki has historically been frugal. While rivals have poured capital into electric vehicles, EVs, and hybrid technologies, Suzuki has approached the transition with caution, banking on the longevity of internal combustion engines in developing economies. That bet now seems to have turned against them. Consumers in these regions are increasingly gravitating toward technologically advanced, environmentally friendly alternatives, and Suzuki's offerings are beginning to look outdated by comparison. Further compounding the company's woes is a notable decline in global vehicle sales over the past 2 fiscal years. Economic slowdowns across key markets, coupled with supply chain disruptions stemming from global events such as the pandemic and geopolitical conflicts, have hit Suzuki's margins hard. Semiconductor shortages, which have wreaked havoc across the entire automotive sector, dealt a particularly heavy blow. Unlike its larger counterparts, Suzuki lacks the deep pockets and diversified supply networks to absorb such shocks efficiently. As a result, production delays have become frequent, dealer inventories have dwindled, and consumer satisfaction has taken a hit, all of which translate to a drop in both revenue and brand equity. Another telling aspect of Suzuki's financial decline lies in its underwhelming performance in the realm of electric mobility. At a time when the industry is moving aggressively toward electrification, Suzuki's offerings have been minimal and largely experimental. Competitors from China, South Korea, and Europe have taken commanding positions in the EV landscape, while Suzuki remains largely stuck in the early planning and prototype phases. This hesitancy to transition quickly has not only cost the company in potential market share, but also in investor confidence. Stakeholders now question the brand's ability to stay relevant in an era that no longer favors delay or indecision. Even domestically in Japan, Suzuki has faced increased scrutiny. As the government rolls out stricter environmental goals and incentivizes greener transport, the company's relatively low investment in hybrid and electric technology has placed it behind the curve. Its K-car segment, long a staple in the Japanese market, is now under pressure to evolve technologically. Yet Suzuki has struggled to retrofit these small, lightweight vehicles with the necessary updates without dramatically increasing costs. The brand's affordability, once its greatest asset, is now threatened by the very modernization required to stay competitive. Internally, the company appears to be experiencing strain on multiple fronts. While the public-facing message has focused on the macroeconomic environment and shifting regulatory demands, deeper issues lurk behind the curtain. Reports suggest rising operational inefficiencies and a growing disconnect between headquarters and overseas subsidiaries. Leadership has struggled to maintain cohesion across its vast decentralized network. This has led to inconsistent strategies, delayed rollouts of key models, and lackluster marketing efforts in regions where aggressive competition requires clear, bold moves. The result is a company that, despite its legacy and potential, is failing to capitalize on critical moments for reinvention. One of the more silent but devastating forces at play is Suzuki's lagging digital transformation. In an age where automakers are rapidly becoming technology companies, integrating advanced infotainment systems, autonomous driving features, and cloud-based vehicle ecosystems, Suzuki's conservative approach has proven costly. Its vehicles, while reliable and efficient, lack the kind of digital polish that consumers have come to expect even in entry-level segments. From connectivity features to driver assist systems, Suzuki has offered little innovation, leaving its cars feeling increasingly archaic. That perception, in turn, has begun to erode its appeal among younger, tech-savvy buyers, a demographic critical for future growth. Labor costs and retention issues have also added to the mounting pressure. As Suzuki tries to retool its workforce to align with modern automotive demands, it finds itself caught between a legacy staff proficient in conventional manufacturing and a younger generation skilled in software and high-tech engineering. The transition has not been smooth. Training programs have been inadequate, and the company's corporate culture, known for its rigidity, has struggled to adapt to the more dynamic, innovative thinking that the industry now demands. Morale within certain sectors of the company is said to be declining, contributing further to inefficiencies and a slowdown in product development timelines. In terms of financial reporting, several red flags have begun to surface. Analysts have pointed to shrinking profit margins, growing debt levels, and a worrying decline in cash reserves. While not yet catastrophic, these trends suggest a company on the brink of having to make difficult decisions, whether through asset sales, downsizing, or strategic partnerships that may dilute its control. The balance sheet is no longer the fortress it once was, and Suzuki's ability to weather prolonged financial hardship is increasingly being questioned by market observers. Investors, once loyal due to Suzuki's dependable performance in emerging markets, are beginning to express concern. Share prices have shown volatility in response to the CEO's announcement, and speculation is mounting about potential restructuring moves. Some believe Suzuki may have to consider retreating from certain markets to consolidate resources. Others whisper of potential acquisitions or mergers, a scenario that would have seemed unthinkable a decade ago, but now looms as a strategic lifeline. Whatever the future holds, the current moment marks a stark inflection point. A quiet giant forced to confront the reality that its foundational strategies may no longer be sustainable. The implications of this financial downturn extend beyond Suzuki itself. Suppliers, many of whom are smaller firms deeply embedded in long-standing contracts with the automaker, now face an uncertain future. Any cost-cutting measures or shifts in production plans could ripple across hundreds of companies reliant on Suzuki's continued health. In regions like India, where Suzuki holds a dominant position, the economic impact could be far-reaching. Local economies built around its manufacturing hubs would face the risk of job losses and reduced commercial activity, especially if production slows or factories close. There is also a reputational cost that is difficult to measure but no less significant. For decades, Suzuki has cultivated an image of simplicity, trustworthiness, and affordability. It has thrived by delivering exactly what was needed, no more, no less. But in today's dynamic, expectation-driven automotive landscape, that minimalist approach no longer suffices. Falling behind is not just a financial issue, it's a branding issue. If Suzuki is perceived as a brand that lacks innovation, lacks ambition, or worse, lacks relevance, then the damage to its long-term position in the global market could be profound. Toshihiro Suzuki's revelation, while courageous, may have come at a precarious time. The company is facing pressure from all angles. external competition, internal disorganization, technological obsolescence, and now, financial vulnerability. The announcement signifies a breaking of the silence, an admission that the problems are not just bumps in the road but potential fault lines. While the broader automotive industry braces for transformation, Suzuki finds itself in a reactive posture, trying to recalibrate while the world accelerates around it. This is not merely a story about financial spreadsheets and sales charts. It is a broader narrative about evolution and resistance to change. A story about a legacy company trying to hold on to its core identity in a world that demands reinvention. Suzuki's troubles are not entirely unique in a sector experiencing upheaval, but the extent of its vulnerability, especially given its previous image as a steady, humble performer, is deeply sobering. The road ahead will require not just fiscal discipline but visionary leadership, aggressive innovation, and perhaps most of all, a willingness to let go of the past in order to build a viable future. For now, the admission from the top has laid bare what many suspected, that even the most enduring companies are not immune to the pressures of transformation. Suzuki's financial problems are a stark reminder that in today's automotive world, complacency is not an option, and survival, let alone success, demands nothing short of reinvention at every level. As the veil has been lifted on Suzuki's deepening financial challenges, attention now turns to the structural and systemic dynamics that contributed to the crisis. Beyond the visible and headline-worthy factors, dwindling sales, inadequate EV infrastructure, or market turbulence, lies a more nuanced reality. A company burdened by legacy systems, entrenched in traditionalism, and hindered by a risk-averse corporate philosophy that has become ill-suited for the pace of modern industry. At the heart of Suzuki's predicament is an outdated operational framework that has struggled to adapt to the 21st century business environment. Many of Suzuki's plants, particularly those in Japan and India, still rely on production methodologies that, while efficient by the standards of the past, no longer deliver the agility and flexibility demanded by today's volatile global supply chains. Robotics integration, AI-powered quality control, and modular manufacturing, once emerging trends but now industry standards, remain underutilized within Suzuki's global operations. These inefficiencies increase production costs, lengthen turnaround times, and limit the company's ability to pivot quickly when faced with demand shocks or logistical bottlenecks. Additionally, Suzuki's vertical integration strategies, once a source of competitive advantage, have started to show strain. While maintaining control over everything from parts manufacturing to vehicle assembly allowed for cost efficiency and consistency in the past, this model now limits the firm's ability to leverage innovation from third-party suppliers and startups that are redefining the automotive experience. While rivals like Toyota and Volkswagen are rapidly forming joint ventures and alliances to access cutting-edge technologies, Suzuki remains more insular in its approach. The hesitation to collaborate or share technological platforms has led to a slower rate of innovation and product refreshment. One glaring area of concern lies in Suzuki's underinvestment in software. As vehicles evolve into connected, semi-autonomous platforms, the distinction between automotive engineering and digital architecture has all but disappeared. Competitors are now hiring thousands of software engineers, integrating over-the-air update capabilities, and building ecosystems that connect drivers with everything from navigation to entertainment to diagnostics. Suzuki, in contrast, still treats software as an accessory rather than a central pillar of its product strategy. This not only narrows its appeal in the consumer market, but also limits its ability to generate post-sale revenue through software services, a rapidly growing segment in the industry. Globally, automakers are diversifying their revenue streams in response to declining margins from vehicle sales. Subscription models, fleet data monetization, and smart vehicle apps are turning cars into platforms for continuous engagement. Suzuki's inability to participate in this evolution has left it dependent almost entirely on upfront vehicle sales, a model that is increasingly unsustainable in today's economic climate. With fewer ways to extract ongoing value from customers after a sale, the company is forced to rely on volume, something it is now losing to competitors who offer more compelling integrated vehicle ecosystems. Then there's the issue of product diversification, or rather, the lack of it. While Suzuki has traditionally excelled in compact cars and small displacement motorcycles, Its reluctance to expand into larger vehicle categories, such as SUVs, crossovers, or luxury EVs, has significantly limited its global competitiveness. Consumer preferences have shifted dramatically in the past decade, especially in growing economies where rising middle classes seek aspirational, tech-enhanced vehicles. By sticking primarily to low-cost compact cars, Suzuki has found itself increasingly pigeonholed in the lower end of the market, which is also the most saturated and price-sensitive. With razor-thin margins and cutthroat competition, this segment no longer offers the strategic safety it once did. The financial repercussions of poor diversification are clear when examining Suzuki's regional exposure. The company is heavily dependent on a few key markets, most notably India, which accounts for nearly half of its global vehicle sales. While this dominance was once a feather in its cap, the lack of geographic balance now represents a significant vulnerability. Any economic downturn, regulatory change, or consumer sentiment shift in India reverberates disproportionately across Suzuki's global operations. In recent years, the Indian automotive market has undergone a transformation. Cleaner energy mandates, GST reforms, and a growing appetite for premium vehicles have started to push Suzuki to the margins of its own stronghold. In contrast, its performance in Western markets has remained tepid at best. The brand's footprint in Europe, North America, and Australia has shrunk over the past decade due to both strategic retreat and consumer disengagement. Without a compelling EV lineup or a strong safety tech portfolio, Suzuki's models often fail to meet the expectations of regulators and buyers in these regions. As a result, its global brand visibility has declined, which not only hurts direct sales but also diminishes its ability to attract talent, investors, and partners. A global company that loses relevance in major markets eventually faces a credibility crisis, even in areas where it still enjoys dominance. Brand perception, though intangible, plays a critical role in financial resilience. Once known as the champion of affordability and reliability, Suzuki now finds itself fighting an uphill battle to maintain consumer trust. Modern buyers view vehicles as expressions of identity and lifestyle, and Suzuki's products, though competent, often lack the emotional or aspirational pull found in brands that emphasize design, digital features, and sustainability. This is especially problematic as millennials and Gen Z buyers become the dominant force in automotive purchasing. Their expectations are not shaped merely by fuel efficiency or cost, but by connectivity, performance, environmental impact, and user experience, areas where Suzuki has little to showcase. The company's marketing approach has also failed to evolve with the times. While others have embraced influencer-led campaigns, digital-first strategies, and immersive product launches, Suzuki continues to rely on conventional advertising and dealership-based engagement. This makes it difficult to capture attention in a media landscape defined by virality and short attention spans. As marketing becomes more experiential and driven by social proof, Suzuki's lack of brand narrative and digital charisma places it at a significant disadvantage in reaching younger audiences. Financing models present another dimension of concern. Suzuki's traditional business has relied heavily on conventional dealership financing and mass-market affordability, but the global shift toward leasing, subscription services, and flexible ownership models, especially in urban environments, is accelerating. Consumers in large cities increasingly prefer access over ownership, expecting car makers to offer seamless, app-based, commitment-light alternatives to buying. In this respect, Suzuki's model appears increasingly outdated. The absence of robust digital platforms or services for vehicle leasing, fleet management, or car sharing compounds the company's irrelevance in this emerging paradigm. From an environmental, social, and governance (ESG) perspective, Suzuki is also on the back foot. As global investors put more weight behind companies with clear ESG commitments, Suzuki's relatively low profile in sustainability disclosures and green initiatives has made it less attractive to impact-focused capital. While competitors publish detailed sustainability roadmaps, invest in carbon offset projects, and pursue circular economy practices, Suzuki has remained largely reactive. Its low-carbon strategies lack the scope and ambition seen elsewhere in the industry. This isn't just a public relations issue. It directly affects capital access, shareholder trust, and partnership opportunities. Human capital challenges also loom large. As the automotive industry undergoes a once-in-a-century transformation, talent acquisition has become fiercely competitive. Engineers, designers, and data scientists now prioritize companies known for innovation, culture, and technological advancement. Suzuki, with its image rooted in conservatism and mechanical simplicity, has struggled to attract and retain top-tier talent. Its internal training programs, while solid for traditional automotive roles, are not designed for the interdisciplinary, fast-paced nature of the modern mobility ecosystem. This talent gap hampers the company's ability to rapidly develop new products, digitize its operations, or foster a culture of experimentation. Meanwhile, the financial pressure is forcing Suzuki to make unpalatable trade-offs. With R&D budgets stretched thin, the company is increasingly having to choose between immediate compliance updates and long-term innovation projects. Safety systems, autonomous capabilities, battery development, and platform modernization, all critical to future competitiveness, are being delayed or underfunded. This creates a vicious cycle. Delays lead to outdated products, which lead to lower sales, which further strain the budget and deepen the innovation lag. Breaking out of this cycle would require bold financial restructuring and strategic reinvestment, both of which are difficult under current cash constraints. The strain is also showing up in dealer networks. Across Asia, Latin America, and parts of Eastern Europe, Suzuki dealerships are reporting lower foot traffic, inventory shortages, and declining service revenues. In some markets, dealers have begun seeking alternative partnerships, fearing that Suzuki may no longer deliver the kind of product pipeline needed to sustain customer interest. As dealer confidence wanes, Suzuki risks losing one of its most valuable assets: local networks of trusted brand ambassadors who, in many countries, have built decades-long relationships with buyers. Another pressing challenge relates to Suzuki's global logistics and parts ecosystem. The company's just-in-time inventory practices, once admired for their efficiency, have now been exposed as brittle under stress. Events like the Suez Canal blockage, semiconductor shortages, and regional lockdowns demonstrated that lean supply chains, while cost-saving, are highly vulnerable. Suzuki's lack of buffer stock, alternative sourcing agreements, and logistics digitization has left it especially vulnerable to prolonged production halts. These interruptions erode customer satisfaction, increase operational costs, and result in lost market share, particularly damaging when fighting to maintain relevance. Beyond immediate financial implications, there's the looming risk of reputational damage within the investment community. Credit rating agencies may begin downgrading Suzuki's outlook if current trends persist, leading to higher borrowing costs and tighter capital availability. Institutional investors may also demand governance reforms, especially if they perceive current leadership as too conservative or slow-moving. Under this lens, even Suzuki's corporate structure, long dominated by internal promotions and familial continuity, could come under scrutiny. Calls for more independent oversight, external talent at the executive level, and performance-linked remuneration may grow louder. What's particularly troubling for analysts is that Suzuki does not have a clear strategic narrative for recovery. While the company has acknowledged its financial issues and shifting market dynamics, it has yet to articulate a roadmap that signals bold transformation. There is no flagship EV platform in the pipeline generating buzz, no major technological leap to excite the markets, and no clear international expansion strategy beyond existing strongholds. In an industry driven by forward-looking vision and disruptive momentum, Suzuki's inertia is becoming increasingly costly. Moreover, cultural rigidity within the organization appears to be a significant barrier to change. Employees across global offices describe a culture of deference, slow decision-making, and reluctance to challenge the status quo. Innovation in such an environment becomes a slow and often watered-down process. For Suzuki to stage a comeback, it would not only need financial restructuring and technological acceleration, but also a cultural revolution, one that empowers teams, flattens hierarchies, and embraces calculated risk-taking as a necessity rather than a gamble. The situation is a study in how even legacy strength can erode in the absence of proactive adaptation. Suzuki's historical advantages, lean production, cost leadership, and emerging market dominance, are now proving insufficient in a world that values speed, adaptability, and vision. The company stands at a crossroads where survival hinges not on incremental adjustments, but on a willingness to reimagine every facet of its identity and operations. As the dust settles on Toshihiro Suzuki's revelation, what becomes clear is that the coming months will be critical, not only in financial terms, but in defining what kind of company Suzuki chooses to become. Will it double down on tradition, hoping to ride out the storm, or will it take the plunge into reinvention, embracing software, electrification, new business models, and global diversity with the urgency the moment demands? That answer, still in gestation, will not just shape Suzuki's destiny, but serve as a powerful case study for every company navigating the age of disruption. Because at its core, this is not simply a financial story. It is a story of industrial transformation and how even the most trusted brands can find themselves outpaced by a world they helped build but hesitated to follow. Suzuki's emerging financial crisis, as disclosed by CEO Toshihiro Suzuki, reflects more than just a downturn in business. It exposes a strategic vulnerability rooted in inertia, fragmented modernization efforts, and missed opportunities. As the auto industry reshapes itself around digitization, electrification, and sustainability, Suzuki's delayed engagement with these imperatives has created a structural misalignment between its core operations and the trajectory of the global automotive sector. One of the most pressing dimensions of this misalignment is Suzuki's failure to cultivate robust innovation pipelines. Unlike companies that nurture internal research hubs or partner with universities, startups, and incubators, Suzuki's approach to innovation has remained heavily centralized, conservative, and oriented toward mechanical refinements rather than paradigm-shifting technologies. This aversion to exploratory R&D, especially in the fields of artificial intelligence, mobility as a service, and battery chemistry, has placed it several steps behind companies aggressively pursuing the future of transport. Innovation for Suzuki has largely remained within the boundaries of improving existing products, rather than imagining entirely new mobility experiences. This innovation gap has also affected Suzuki's ability to enter the highly dynamic space of mobility services. As urban centers worldwide continue to reimagine transportation, from shared electric scooters and subscription-based vehicles to AI-enabled ride-hailing, Suzuki has not ventured meaningfully into any of these domains. Startups and legacy automakers alike are rapidly diversifying, turning vehicles into platforms that deliver services rather than just convey passengers. Suzuki, still largely rooted in a sales-centric model, has failed to enter this space where recurring revenues, data collection, and digital ecosystems create long-term brand engagement and financial resilience. Its reluctance to evolve from a vehicle manufacturer into a mobility provider has diminished its future relevance. There is also a notable absence of leadership visibility in the emerging global discourse on automotive sustainability. Executives from many automotive giants regularly appear at global energy summits, climate forums, and technology expos, helping to shape narratives and form alliances that influence policy and market direction. Suzuki's executive bench, by contrast, remains relatively silent in these arenas. This absence from the global dialogue further sidelines the company's influence in shaping the very future it must soon compete within. Without a seat at the table, Suzuki's ability to adapt to forthcoming regulations, shifts in public infrastructure, and green financing instruments is weakened. Adding to these challenges is a strategic blindness toward brand repositioning. While other automakers have undertaken bold efforts to reinvent their image, pivoting toward sustainability, luxury, youth appeal, or tech savviness, Suzuki's brand has remained static. It still communicates primarily through attributes like affordability and simplicity, which, although once powerful, now fail to convey modernity or ambition. Branding today is about signaling alignment with values like environmental consciousness, technological sophistication, and social responsibility. Suzuki's failure to evolve its brand identity has effectively walled it off from engaging with the rapidly growing segment of conscious consumers who factor ethics and innovation into purchasing decisions. This disconnect extends to product design language and visual storytelling. Across automotive sectors, companies are embracing futuristic aesthetics, minimalist interiors, and technology-integrated dashboards that reflect changing consumer expectations. Suzuki's models, though reliable, often present dated interior ergonomics and exterior forms. The lack of visual ambition hinders their ability to excite the imagination or establish an emotional connection with consumers. In an era where buyers compare vehicles not only on horsepower or price, but on design appeal, perceived tech savviness, and environmental branding, Suzuki's conservative styling appears uncompetitive. A crucial oversight in Suzuki's business model has also been its neglect of vehicle software updates and post-sale technological upgrades. As software-defined vehicles become the industry norm, automakers are leveraging connectivity to improve vehicle performance, safety features, and user interfaces long after a vehicle leaves the lot. This software-first approach not only extends product life cycles, but generates continuous revenue and keeps customers engaged. Suzuki, lacking a mature software delivery infrastructure, remains heavily dependent on traditional update models, meaning customers must visit dealerships for updates that could otherwise be done remotely. This gap is not merely technical, it is strategic, as it eliminates the possibility of fostering long-term digital engagement. If you like this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on Suzuki's huge financial problems? What do you expect next? We want to hear from you. Thank you for watching and see you next time.